Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Yeah, and we have a really fascinating topic today.
We really do. I want you to just think about two people retiring today. They both have exactly $1 million sitting in their investment accounts.
Right. On paper, they look completely identical.
Exactly, completely identical.
Right.
But, one of them is financially bulletproof, just totally secure in their future.
Mm-hmm.
And the other one is basically standing on the edge of a cliff. Like, they are just one minor economic shock away from running out of money entirely.
It's a scary place to be.
It is. And look, it is July 6th, 2026. No matter what your personal politics are, under the current Trump administration, the broader economy, the cost of living, inflation, these are massive talking points dominating your dinner table.
Oh, absolutely. Everybody is talking about it.
Right. You feel it when you look at your insurance premiums or when you check out at the grocery store, and definitely when you open your utility bill.
Yeah, you just can't escape it right now.
You really can't. But today, our mission for this deep dive is completely apolitical. We aren't looking at government policy.
No, not at all.
We are looking at recent analysis that completely redefines what a successful retirement actually looks like in modern America.
And it really flips the whole script, honestly.
It does, because it starts by shifting focus away from that, that obsession with the magic $1 million number.
Right, the golden nest egg.
Yeah, exactly. And looking instead what the data calls your dignity baseline.
The dignity baseline. I love that term.
Me too. So break that down for us. What exactly is a dignity baseline?
So the dignity baseline is essentially the bare minimum amount of money you actually need to spend, like on a monthly basis, to feel good about yourself and your life.
Okay.
Because for decades, the entire financial services industry has trained you to just focus on the pile of money.
Right. Like just get to $1 million.
Exactly. The goal has always been to hit $1 million or 2 million, and then boom, you cross the finish line, you're done.
Yeah. Pop the champagne.
But the research we are looking at today argues that the real secret to retirement isn't the size of your portfolio at all.
Wait, really? It's not.
No, it's actually the size of your lifestyle.
Yeah.
It is about understanding the raw, fundamental math of your day-to-day cash flow.
Okay, which brings us back to those two hypothetical retirees, right? The ones with $1 million each.
Right, exactly.
How does the math actually separate them in the real world?
It all comes down to their fixed costs. So let's say person A has engineered a lifestyle that requires $30,000 a year to live comfortably.
Okay. So pretty modest.
Yeah, but person B has built a lifestyle that demands $100,000 a year.
Oh, wow. Okay, that's a huge difference.
It is. So person A can easily pull $30,000 from $1 million portfolio. That's just a very safe 3% withdrawal rate.
Right, which means they are highly resilient to market crashes.
Exactly. They can sleep like babies. But person B, they have to pull 10% of their portfolio every single year just to survive.
Just to keep the lights on and pay for their lifestyle.
Yeah. So if the market dips, person B is in severe danger of draining their entire life savings super fast.
That's terrifying.
It really is. And looking at the data, this vulnerability is causing widespread panic right now.
What do the numbers look like?
Well, according to the Natixis 2025 Global Retirement Index, a massive 69% of investors globally feel that inflation is actively destroying the value of their retirement.
69%. That is wild.
It's huge. And furthermore, 66% report they have had to actually reduce their current savings rate just to keep up with their daily cost of living.
Wow. So you are basically getting squeezed from both ends.
Exactly.
Like your current living costs are so high, they eat into your ability to save for tomorrow. And meanwhile, inflation is eating the purchasing power of the money you've already managed to put away.
Yep. It's a vicious cycle.
It's like, okay, think about it like this. It's like buying a massive $80,000 gas-guzzling SUV.
Oh, that's a good analogy.
Right. Sure, it looks fantastic in your driveway, and your neighbors are super impressed.
Oh, yeah, they definitely notice.
But you are stressing out every single day about the price of gas at the pump. You built a machine that demands constant, really expensive fuel just to move forward.
Exactly. You're trapped by your own machine.
Meanwhile, the guy driving the reliable little hybrid, he doesn't care if gas prices spike.
No, he's totally fine.
Yeah, he just doesn't need much fuel to get where he's going.
Right. The person in the hybrid has just engineered a more efficient life. They aren't suffering or depriving themselves.
They still have a car.
Exactly. They just lowered the mechanical requirements of their daily existence.
Which is huge.
It is, because controlling your fixed costs, things like your mortgage, your car payments, your insurance, your recurring subscriptions, it's not just some moral virtue about being frugal.
Right. It's not about clipping coupons.
No. Lowering your fixed costs is a highly powerful financial option. Think about it. The stock market is completely out of your hands.
Oh, completely.
Global interest rates are out of your hands, but your household budget, that is entirely within your control.
So, given that, why do you think you constantly see people obsessing over those massive macroeconomic things?
What do you mean?
Like, people are always freaking out over Federal Reserve rate hikes or stock market swings instead of just looking at their own monthly budgets. Why is that?
Well, I think it's because society tells you that retirement is purely an investment problem.
Ah, like it's just a math equation for Wall Street.
Exactly. You are trained to chase yield. You watch financial news networks that basically gamify the stock market.
Yeah, with all the flashing red and green numbers.
Right, making you feel like if you just pick the right tech stock, all your financial worries will instantly disappear.
But the reality is a bit different.
Very different. The math just doesn't support that. When you lower your baseline requirements, you are essentially reducing the amount of risk you have to take in the stock market just to survive.
That makes so much sense.
Yeah, if your fixed costs are low, you don't need your portfolio to generate massive risky returns. You just take back the driver's seat.
Right, and that fixed cost baseline becomes incredibly important when you look at how much longer those dollars actually have to stretch these days.
Oh, absolutely. Longevity is a huge factor.
Because the traditional definition of retirement, that hard stop at age 65, where you get a gold watch and a pension that's basically vanishing.
It's totally gone for most people.
Yeah. And the OECD 2025 pensions at a glance data just came out, and it paints a pretty stark picture of an aging world.
It really does. The demographic shift is like the underlying tectonic plate moving beneath all of this financial advice.
What did the OECD data show?
Well, by the year 2050, the ratio of retirees to working age people is going to jump drastically.
How drastically are we talking?
Right now, there are about 33 retirees for every 100 working age people in developed nations.
Okay, 33 per 100.
But by 2050, that number jumps to 52 retirees per 100 working age people.
Wow. Okay, break that down mechanically for us.
Well,
Like, instead of 3 workers paying taxes into the system to support 1 retiree, it's going to be closer to 2 workers supporting 1 retiree.
exactly. And that is a massive structural strain on the social safety net.
Yeah, the math of public pensions and social security systems just gets incredibly stretched under that weight.
It does. There are fewer tax dollars flowing in and more benefits flowing out.
Which is why normal retirement ages are already creeping up past 66 across many developed nations.
Right. And the data suggests they will likely keep climbing. You simply cannot rely entirely on a strained government system, right, or a volatile stock market to fund a 30-year vacation.
So what's the alternative?
Yeah.
Because nobody wants to just work at a desk until they're 80.
No, of course not. To combat this reality, the analysis points to a highly effective strategy called the pension combo lifestyle.
The pension combo lifestyle. I like the sound of that.
Yeah, it's pretty neat.
So that means combining your investment drawdowns, basically the money you pull from your savings, with light part-time work or freelance gigs.
Exactly. You don't turn off the income faucet completely.
You keep a trickle running.
Right.
But hold on, I have to push back here.
Okay, go for it.
If I tell my uncle to go work at a coffee shop at 68, he's going to look at me like I'm crazy.
Oh, I'm sure he would.
Because, we have all been sold this American dream where working in retirement is seen as a complete failure of capitalism.
Yep, that's the stigma.
We want the fantasy. You want to sit on a beach in Florida at 65, play golf, and literally never look at an alarm clock again.
Who wouldn't want that?
Right. So doesn't working in your late 60s or 70s mean you somehow lost the game?
See, that mental block is the exact psychological hurdle you have to overcome.
Really?
Yes. The cultural narrative tells you that working at 70 is a punishment. But the financial data completely reframes this.
How so?
Work in retirement is not a failure. It is actually a portfolio defense mechanism.
A portfolio defense mechanism. Okay, explain how that mechanism actually works in the math of a retirement account.
It addresses something called sequence of returns risk.
Which is what, exactly?
Okay, let's go back to your $1 million portfolio example. Imagine you retire on a Monday.
Great day to retire.
Right. But on Tuesday, a severe global recession hits. The stock market takes a 30% dive.
Oh, brutal.
Yeah, so your portfolio is instantly knocked down from $1 million to $700,000.
Ouch.
Now, if you are 100% reliant on those investments and your lifestyle requires $50,000 a year, you are forced to sell off your stocks at rock bottom, depressed prices.
Just to buy groceries and keep the lights on.
Exactly.
And selling at the bottom is the absolute cardinal sin of investing.
Because you've permanently locked in that loss, there's no coming back from it.
Man, the math gets punishing from there, doesn't it?
It does. To get that remaining money back up to your original $1 million, you don't just need a 30% gain to recover.
Right, because your principal is now much smaller.
Yes.
Yeah.
You actually need a massive 50 to 60% gain just to break even.
Which could take years.
Decades, even.
Yeah.
But if you have a portfolio defense mechanism, let's say a low-stress part-time gig that brings in $25,000 a year.
Okay, so you have that trickle of income.
Exactly. Now you only need to pull half as much money from your investments during that crash.
Oh, I see.
You preserve your shares, you give them time to ride out the recession and recover.
It's like the shock absorbers on a car.
That is a perfect way to put it.
Right. Like if your portfolio hits a massive pothole, like a recession or a crazy inflation spike, that part-time income absorbs the impact so the chassis of your life savings doesn't crack under the pressure.
That is exactly how it functions mechanically. And honestly, beyond the math, the research consistently shows that light, enjoyable work provides major life benefits.
Like what?
Like social connection, mental sharpness, and a healthy daily routine.
That makes sense.
Yeah, those are critical health factors that people often lose rapidly when they abruptly go from working 50 hours a week to doing absolutely nothing.
Okay, the math makes total sense. But let's be real. To successfully execute this combo lifestyle, you have to overcome a massive ego trap.
Oh, the ego trap is huge.
Right. Society fiercely judges the kind of work you do. You have to be okay doing jobs that might be seen as, well, lesser by your peers.
Right, like working retail.
Yeah, or living more modestly than your friends who are still trying to project massive wealth on social media.
The psychological side of money is often the hardest part of the entire equation.
I bet.
According to the recent analysis we reviewed, self-esteem is quite literally a financial asset.
Oh, wait, self-esteem is a financial asset. That's fascinating.
It really is. A person with high self-esteem can take a fun, low-stress job, working at a local hardware store, or being a barista at a coffee shop, or doing some light consulting for a small business.
And they can do it without feeling an ounce of shame.
Exactly. They do not care what the neighbors think about their job title.
But someone whose entire identity is wrapped up in being a senior vice president or driving a certain brand of luxury car, I mean, they couldn't bear to be seen making lattes.
No, it would crush them.
And because they refuse to take on that light work, they remain entirely vulnerable to the stock market.
Yep. The MarketWatch 2026 Retirement Confidence Survey highlights this vulnerability perfectly.
What did that survey find?
It shows just how deeply retirees are currently worrying about inflation and maintaining their lifestyle costs. The fear of losing social status is incredibly expensive.
Oh, that is so true.
You end up spending down your portfolio just to prove to other people that you still have money.
It's like keeping a wildly expensive country club membership just because your neighbors do.
Yes. Perfect example.
You might not even like golf,
Mm-hmm.
but you pay $2,000 a month just to keep up appearances.
Exactly.
But if you just drop the membership, if you let go of that ego, you instantly buy back your time.
You buy back your life, really.
Yeah. You suddenly have the financial freedom to take a fun, low-stress job at a local bookstore instead of grinding at a high-stress corporate gig just to pay your country club dues.
And that's the beauty of it. Simple living isn't about forced poverty or deprivation.
Right.
It's about declaring independence from other people's expectations. When you untether your spending from your ego, your vulnerability to inflation drops significantly.
Because you aren't forced to buy the expensive stuff anymore.
Right. If the price of steak doubles, you can happily eat chicken. If you don't need a luxury car to feel successful, a spike in auto prices doesn't ruin your day.
That is so empowering.
The secret here is that when your spending is flexible and completely detached from your ego, you become incredibly resilient to whatever the economy throws at you.
Okay, so we've covered the mindset shift. You move from the myth of the magic million to focusing on your dignity baseline.
Check.
And you reframe part-time work as a shock absorber rather than a failure. Conceptually, this is powerful stuff.
It's life-changing if you apply it.
But how do you actually execute this? The analysis synthesizes this into 3 essential skills for modern retirement, right?
Yes, the data points to 3 distinct abilities you need to master. First, the ability to spend less, which we've established is all about independence.
Spend less.
Second, the ability to earn longer. And third, the ability to invest longer.
Okay. Spend less, earn longer, invest longer.
And the data shows you really need to act on these quickly because there is a serious illusion of safety out there right now.
An illusion of safety.
Yeah, the BlackRock 2026 Red on Retirement report exposes a very dangerous confidence gap.
Explain that confidence gap for us. Are people simply assuming they are fine when the math says otherwise?
Basically, yes. The BlackRock data shows that 68% of savers currently believe they're fully on track for retirement.
Okay, that sounds positive, right?
It sounds positive until actuaries run the actual numbers on their current balances, factoring in realistic longevity and sustained inflation.
Oh, wow. What happens then?
Well, those balances will realistically only cover about 50 to 60% of their expected needs.
Oh, wow. So they are going to run out of money.
Precisely. The majority of people are severely overconfident. They just haven't accounted for the compounding effect of inflation over a 30-year period.
Man, that brings up a terrifying variable when it comes to that second skill, the ability to earn longer.
It really does.
Because, you might plan to work until you were 70, but what if your industry decides they don't need you anymore?
And that is happening right now.
Yeah, the Wall Street Journal data shows that older workers, specifically those 55 and up, are dropping out of the labor force at accelerating rates right now due to rapid technological changes.
Specifically, the rise of artificial intelligence.
Right, AI.
The AI displacement is a critical factor because it is hitting a demographic that traditionally felt very safe.
Yeah, white-collar workers?
Exactly. Historically, automation replaced physical blue-collar labor on the factory floor. But generative AI is entirely different. It targets knowledge work.
It's coming for the office.
It is. It is exceptionally good at summarizing reports, synthesizing data, writing emails, and basic project management.
And those are exactly the mid-level and senior-level management tasks, often held by workers in their late 50s and 60s.
Precisely. These workers are expensive for corporations to keep, and suddenly, software can do 70% of their daily tasks for a fraction of the cost.
So it's not that older workers can't figure out the software.
No, not at all.
It's that the corporate structures that relied on highly paid managers to filter information are being completely flattened by AI.
Correct. Their specific roles are just being evaporated, making it incredibly difficult for them to execute that plan to earn longer in their primary careers.
That is sobering. So for the listener who is maybe in their 40s or 50s right now driving in their car,
Yeah.
they're looking at that BlackRock confidence gap and hearing how AI is systematically flattening middle management. What is the immediate game plan? How do you protect yourself against this starting today?
Okay, so the analysis breaks the game plan down into 3 clear timeframes: short-term, mid-term, and long-term.
All right, let's start with short-term.
If you are looking at the short term, meaning the next 1 to 3 months, your only job is to do a ruthless audit of your fixed costs.
Ruthless. I like that.
You sit down with your bank statements and categorize every single expense. Separate what you pay for survival, what you pay for genuine joy, and what you pay for ego.
Ah, so you identify the country club dues versus the bookstore lifestyle.
Exactly. And you cut the ego expenses immediately.
Because every dollar matters.
Well, the mechanical reality is that every dollar you cut from your fixed costs is a dollar you do not have to earn, pay taxes on, and then save for 30 years.
That's a huge multiplier effect.
It is. Cutting fixed costs is the most instantaneous way to drastically improve your retirement math.
Okay, so 1 to 3 months. Ruthless fixed cost audit. What happens in the midterm?
For the midterm, looking at the next 6 to 18 months, you need to start developing what the analysis calls AI resilient skills.
AI resilient skill.
Yeah. Since you need the ability to earn longer, you have to find ways to generate income that won't be immediately automated by a language model.
Okay, so what does that look like in the real world?
This means leaning into highly human skills. Things like direct consulting, relationship-based sales, community building, or specialized physical niche trades.
Things a computer just physically can't do.
Right. The goal over these next 18 months is to develop a low physical stress, highly human skill that can generate a reliable side income later in life.
Which is what allows you to easily step into that pension combo lifestyle.
You got it.
You basically build the shock absorber for your portfolio before you actually hit the pothole.
Exactly. You want to have it ready to go.
That makes perfect sense.
Oh.
And what about the long-term strategy?
Long term, you must structure your portfolio to survive a 30 to 40-year time horizon. A common mistake is investing just to get to the finish line of age 65.
All right, people think they hit 65 and the game is over.
But you actually have to invest to get through age 95.
That's another 30 years.
Yeah. This means you cannot just dump everything into ultra-safe bonds that will lose to inflation over time. You need a careful balance.
A balance between what?
You need growth assets, like equities, to outpace inflation over the decades, combined with stable, cash-flowing assets to cover your immediate baseline needs during market dips.
Okay, that makes sense.
But crucially, this long-term investment strategy only survives if you have already mastered the short-term cost control and the mid-term earning potential we just discussed.
Right, because if your costs are too high, you drain the portfolio anyway.
Exactly. They all work together.
When you put all of these pieces together, the entire picture of what it means to be financially secure really flips upside down.
It's a total paradigm shift.
We started today talking about this looming cultural anxiety over inflation and this exhausting obsession with hitting a massive $1 million or $2 million nest egg.
Yep. The old way of thinking.
But the journey through the data points to a completely different paradigm. It really highlights the profound empowerment of the pension combo lifestyle.
It does. And, the ultimate takeaway from all the research is that the true secret of wealth in retirement isn't being the person with the largest bank account.
No.
No. It's being the person who requires the absolute least amount of money to maintain a high level of life satisfaction.
Wow.
When your needs are small, your freedom is massive.
The person in the hybrid is sleeping soundly, while the person with the massive SUV is staring at the ceiling at 3 a.m. worrying about the price of gas.
Exactly.
It's such a profound shift in perspective. It takes the locus of control away from the chaotic global economy, away from the Federal Reserve, away from the stock market.
And puts it right back into your own hands.
Right at your own kitchen table.
And that is exactly where your financial control should always be.
It really is.
Yep.
So as we wrap up this deep dive into the data, I want to leave you with a final challenge to ponder on your own this week.
Oh, a challenge. Let's hear it.
Take a hard look at your bank statement this month. Go line by line through your credit card bill. Which of those expenses are bringing you genuine deep joy, and which ones are you simply paying to maintain an image for people you don't even really like?
Ouch. That's a tough question.
It is. But if you cut those ego expenses today, you just might buy back years of your own freedom. Don't forget to subscribe and hit that like button.